Hey, what's up everyone? This is Silver Slayer. Thank you for tuning into this video. Right now, looks like gold and silver are in the green. Gold at $1,502, up $14.16. Silver at $12.81, up 20 cents on the day. Are we going to see $13 silver next? Are things to the upside? We still see a 15 plus business delay or day delay, and also a $300 order minimum, and this is with most bullion dealers as well. So this article from Seeking Alpha is going to be talking about how the Fed is shooting blank bullets, a false sense of security after the 2008 global financial crisis. The Fed controls nearby rates that are now at zero, struggle with the yield curve, and pulling out all the stops to avoid another credit crisis, printing money without abandon and government bailouts. Gold will be the ultimate winner. See, precious metals are always going to come out on top when this stuff happens. This is because gold and silver have real intrinsic value. Don't forget the true value of silver. It's easy to get desensitized to prices right now as they're lower, but you have to remember the bigger picture. The bigger picture is that gold and silver are always and have been always a means of value. And that's never going to go away, especially with the demand rising and the shortages happening. It's only likely that silver prices are going to be going upwards. So the link to this article will be in the description if you want to check it out yourself. Like always, with that said, make sure to smash that like button. Let's see if this video can get 100 likes. Everyone, like the video right now. Go smash that like button. Thank you so much. I know you just did. And make sure you subscribe because I do post daily videos. If you want to stay up to date on a day-to-day basis, I am your guy. So with that said, let's jump into this video. So my first mortgage in the 1980s was over 14%. I remember when the yield curve on the 30-year Treasury bond was at 20% level. When the Fed first cut the Fed fund rates at zero following the 2008 financial crisis and pushed down to historical lows further along the yield curve, the move calmed the markets and avoided a deep recession or worse. The root cause of housing and mortgage-backed security crisis was financial. Lending to borrowers who could not afford to pay back the loans created a mountain of unserviceable debt, which is true, right? Packaging those obligations with the blessing of rating agencies and selling them to investors that did not comprehend the risk was a time bomb that exploded. The bubble's going to pop. And at the same time, the blending of economic systems in Europe set the stage for bailouts of southern European countries to avoid debt defaults. A sea of liquidity calmed the waters and prevented the global financial crisis from becoming an economic nightmare. Central banks emerged as saviors as they provided cash that kept markets going. Just throw a little cash in there, it'll fix the problem, right? The root of the current financial crisis, or the current crisis, is different. It is not financial. The international oil cartel made a move that exacerbated the crisis, but markets were likely heading for carnage anyways. Gold is the one asset that has survived through thousands of years as a store of value, like I was mentioning earlier in this video. In the current environment, almost everything is losing value rapidly. So gold is going to come out on top because gold, regardless of spot price, the value is within itself. So Ben Bernanke, the chairman of the U.S. Federal Reserve during 2008 financial crisis, is an economist who wrote his PhD thesis on the Great Depression. It started with the 1929 stock market crash. So he dug deep into his central bank toolbox to lower the short-term rates to 0% and instituted a program of quantitative easing. Buying government debt securities further along the yield curve pushed interest rates lower to stimulate the economy by encouraging borrowing and spending while inhibiting saving. And the rest of the world followed the U.S. central bank with policies that avoided a deep recession and fostered economic growth. At the same time, fiscal policies in the form of bailouts for financial institutions and other businesses prevented a deterioration of economic conditions in the months and years that followed the crisis. So, after this 2008 debacle, Warren Buffett said, when the tide goes out, it uncovers who has been swimming naked. The tide went out again, starting in late February. The reason for the current carnage in the markets is because the virus that threatens all people around the world, the global economy has ground to a halt. In the absence of business activity, companies will not have any earnings. On March 19th, famed hedge fund manager opened that lesson could rise to 4 trillion. Coronavirus did not come from the financial system, but is highlighting the shortcomings of corporations in the U.S. around the globe. So, coronavirus is exposing the reality behind the scenes of where we're sitting at financially and how our system runs. So, I think that's very important because it's really sharing and it's scaring the economy to a point that people really are second guessing their government. They are second guessing their monetary policies. This is why gold and silver have such a high demand right now. So pulling out all the stops to avoid a credit crisis, printing money without abandon, and government bailouts. Each risk-off or black swan event is particularly challenging because economic activity has ground to a halt. Job losses are mounting. Here in Las Vegas, most people have been furloughed for the next 30 days. As the virus spreads, that could only be the tip of the iceberg. COVID-19 is not on a time clock. There is no way of telling how long it will last or how many people will impact. It will impact. That's very true. We don't know the extent it's going to go. The longer it lasts, the more central bank liquidity will be needed to keep the system afloat, which means they're going to keep throwing more money and more money. The government will need to keep calm with money purchase essentials. The Fed, ECB, and political leaders have all said they will do everything necessary to get through this period. The printing presses are running overtime and will continue. The government will move to bail out any businesses that isn't critical national security. So they're looking like, anyone who's really, really hitting the fan from this, it will get helped. But to what extent is that going to cause? So gold will be the ultimate winner. Here's the meat and potatoes of this article. We are in unprecedented times. During the peak of the most crisis events, it is often a challenge to see the light at the end of the tunnel. That's why I always say try to look at the bigger picture. Because when you can look at the bigger picture, it takes out the emotional attachment right now, and you can look at the markets as they are without speculative opinion. You can look at them realistically. However, the light will appear and there will be a new normal. The cost of the coronavirus has potential to dwarf any other event in history. Wow. That's crazy to think about. It really is. If 2008 is a guide, one asset stands to experience wild volatility that would lead to substantial rally to all-time highs. In 2008, the price of gold fell from just over $1,033 per ounce to a low of $681, a decline of 34.1%. Gold traded to its most recent peak of $1,700 on March 9th before risk-off correction began. The selling in gold could be coming from the holders who are liquidating positions to meet margin calls over or cover significant losses on other markets. A 34% correction would take gold to $1,200 or $1,123. $356 below closing price on March 19th. It is impossible to pick a bottom in the market, where in the current environment makes it even more of a challenge. So they're trying to find a bottom. Where is this bottom? Where can things start moving up from? But it's impossible to find that, especially looking at the economy and how things are still kind of, running around like a chicken with their head cut off. So if history repeats and gold falls to the $1,125 level, the impact of the sea of accommodative monetary policy could ignite a rally that takes gold over $3,000 per ounce in the coming years. Central bank monetary policy decreases the value of currencies as there is no limit in the amount of legal tender they can print when they put out all the stops. There's no limit. They can keep printing forever if need be. However, the increasing stock of gold only comes from extracting more out of the crust of the earth, and this shows where real value comes from, right? Real value is something that cannot be created nor destroyed, and money can be created out of thin air. Gold can't. We have to dig more out, and that's why gold has more potential. So I thought this article highlighted a lot of very good things. I'm not gonna keep going on because it's starting to get to that time frame, but if you wanted to keep reading on it, it kind of explains more on what we're talking about with gold, and I definitely think this is a great article. I skipped some other of the portion of the parts they're talking about. The Fed control nearby rates that are zero. you know, and false senses. We already read that one. So, you know, there is some stuff in here if you want to, like, struggling with the yield curve. And, you know, so I definitely think this is stuff we need to talk about. I know it's scary. I know it's very real. It's very real, but it definitely is stuff that we need to talk about, we need to discuss, and we need to be educated on. So with that said, make sure to smash the like button. If you enjoyed this video, if you thought it was educational, entertaining, or just informational, make sure to smash the like button. Make sure you subscribe if you're new. I do post daily videos. Thanks for tuning in. This was Silver Slayer. I'll see you guys soon. Peace.